Hello everyone, my name is Charlie, and in this presentation I'm going to go over the price action candlestick patterns number 1, covering the Doji. As with any presentation that we do here at Slick Trade, there is a disclaimer. Feel free to pause the video and read through the entire disclaimer. But when trading any financial asset, there's a possibility that you may sustain a partial or total loss of your investment funds. As a result, it is advised you should never invest with or trade upon money which you cannot afford to lose. Trading involves a real risk of loss, and past performance does not ensure future results. So let's get started. What is the Doji? The Doji looks like a cross when viewing your charting platform and has the same opening and closing prices. When Doji appears, you know that price has remained mainly unchanged. This is a display of market indecision, which has the potential to result in a market reversal following a possible consolidation period. So how do we trade the Doji? The Doji is usually traded best when the market has been in a defined trend. For example, if the market has been in a downtrend, the appearance of the Doji could be an indication of the start of an uptrend. You can also use the Doji to avoid entering the market. If price has not been in a defined trend, then use the Doji as an indication to simply avoid until another pattern emerges. In the example to the right, we see here, right here is our Doji, and we were following an overall downtrend, okay? Since this is the potential for a reversal, okay, we would expect that if price broke the previous high, then we could go into an uptrend, okay? And that is what occurred in this example. In this example to the right, we see the Doji, like I just pointed out. And it's following a defined downtrend. Our expectation is that if price breaks above the high of the Doji, then there will be an uptrend following. So right here is the high, and you'd wait until price actually broke a little above that high. Now we have two options as traders. We can either set a pending order for just above that high, or we could wait for the candle body to break the high and enter at market price. Okay. We do not enter until after the full duration of the candle to make sure it is not a fake out. So if you use the pending order method, and let's say price came, shot up and then came back down and closed below that high, then that could be a fake out. Okay, so pending orders are great if you're not going to be around the computer, things like that, but make sure that you're able to get to it so that if it does enter you and price doesn't stay above that high, then you can get out of the trade, okay, because it could simply go into consolidation or continuation of the trend, okay. In this example, price broke and displayed a trend reversal. Now, this is the daily chart, okay, so each one of these candles is 1 day in duration. I find that's the best way to trade, excuse me, most price action setups, but you can do it on lower time frames. You're just going to have a better result with the daily, okay, and a higher win rate with the daily, okay. So in this example right here, this is over 400 pip gain. If you are used to trading shorter term charts such as the minute, 5 minute, 15 minute, even hourly, this move right here may not look like much, okay, but like I said, we're using the daily, so this is a beautiful, beautiful move, okay. So in my next lesson, I'll be covering the Marubozu candlestick pattern. Hope you guys are enjoying this series, and if you have not checked out my previous price action series on candlestick patterns or price action patterns, then definitely check that out as well. I will see you guys then.